SMSG.
Mr. Speaker, I thank members for their support for the bill and their comments and suggestions. Let me respond to the points they raise. Mr. Don Wee, Ms. Nadia Samdin, Mr. Neil Parekh, and Ms. Usha Chandradas spoke on the proposed new tax treatment on foreign source disposal gains. Let me reiterate that the proposed new tax treatment does not represent a shift in our broader tax policy on capital gains. It is not the intent of the proposed amendments in this bill to tax capital gains in Singapore. Instead, the objective of this amendment is to address international tax avoidance risk by entities without real economic activities in Singapore, as well as that relating to foreign source gains from the disposal of intellectual property rights. For the latter, we will adopt the internationally agreed modified nexus approach, which is also currently used for our intellectual property development incentive. As we have designed this proposed change to be as targeted as possible, there should not be significant impact on genuine businesses with real activities here. This move should be seen in the context of our broader policy to align key areas of our tax regime with international standards, such as the rules against harmful tax practices agreed by the Inclusive Framework on BEPS, as well as the EU Code of Conduct Group Guidance. As a small, open economy, it is in our interests for our tax rules to stand up to international scrutiny to facilitate the continued flow of trade and investments. Ms. Chandradas asked about the interaction between the proposed amendment and BEPS Pillar 2 rules. So, they are not related and have different objectives. Pillar 2 global anti-base erosion rules seeks to impose a minimum effective tax rate of 15% on large multinational enterprises, or MNEs, wherever they operate. On the other hand, this proposed amendment aims to address tax avoidance risk associated with foreign source disposal gains and is not confined to large MNEs. Ms. Chandradas and Ms. Nadia also asked how IRAS would assess economic substance and operationalize the proposed change, while Mr. Wee raised some scenarios relating to restructuring transactions, funds, and family offices. The answer is that the tax treatment will depend on the facts of each case. As business practices vary across industries, it will not be possible to prescribe quantitative tests. Nevertheless, IRAS will certainly take sector-specific circumstances into account in administering the new rule. MOF and IRAS have held several engagements with the industry over the last few months to hear businesses' feedback and understand their concerns as IRAS works out the implementation details. IRAS will provide industry with guidance on how economic substance will be assessed to be adequate. Where possible, sector-specific circumstances and common scenarios, including those raised by members of the House, will be considered and addressed in the guidance. I would like to assure members that we will implement the new tax treatment carefully to minimize the impact on genuine businesses while deterring tax avoidance by entities without real economic activities in Singapore. IRAS aims to publish the guidance by the end of this year and will refine it over time based on feedback and consultation with industry partners. IRAS will consider the suggestion from Ms. Chandradas for an expedited advanced ruling framework. Let me also address two technical queries raised by members. First, foreign tax credit will be available based on current tax rules. Second, the proposed amendment will not cover foreign entities that have no operations in Singapore other than the use of banking facilities here. IRAS will include these clarifications in their guidance. Overall, we do not expect the new tax treatment to have a negative impact on our economy, as our focus has always been on attracting and anchoring real economic activities in Singapore. Our global competitiveness will not be affected, as these international standards are also applied in other jurisdictions, so there's a level playing field. So let me now touch on the obligations on intermediaries for self-employed persons or SEPs. Mr. Satyandi Supat sought clarification on whether SEPs can opt out of having their income information submitted to IRAS by their intermediaries. Ms. Jin Si asked how such income information will be used and safeguarded. Intermediaries included in this initiative will need to submit income information of the SEPs whom they have made contracts with. And these SEPs cannot opt out of having their income information submitted to IRAS. The use of such income information is governed and subject to existing safeguards under the Income Tax Act. The information obtained will be used for tax administration purposes, including pre-filing of income tax returns. This will make it more convenient for SEPs to submit their tax filings. They will be able to verify and amend the pre-filled income amount before filing their tax returns. Beyond tax, the income information collected will also help in the administration of social schemes, such as the Workfare Income Supplement Scheme, which I mentioned in my opening speech, and Ms. Mariam Jafar also spoke about this. Picture a 45-year-old SEP earning $1,500 a month. He could have qualified for Workfare, but is not receiving it because he did not file his income tax returns and he did not make Medisave contributions. If the intermediary had submitted his income information to IRAS, he would have automatically qualified for $2,400 of Workfare in 2023. Tapping on intermediaries to submit income information on SEPs could also facilitate the administration of new schemes going forward, including financial assistance during a crisis. For instance, during the COVID-19 pandemic, the SEP Income Relief Scheme, or SIRS, was rolled out to support SEPs. However, as SEP income information was incomplete, the government was only able to automatically disperse the payouts to some SEPs, and NTUC had to process applications from SEPs who did not automatically qualify. Having the relevant data to quickly administer such support schemes will enable SEPs to receive the support more quickly and also simplify administration of these schemes. Mr. Wee, Mr. Satyandi, and Mr. Parekh asked about the extension of this initiative to other intermediaries and whether the intermediaries will be provided with financial support to establish new infrastructure for regulatory reporting. IRAS will adopt a phased implementation approach, starting with commission-paying agencies in the year of assessment 2024, as many of these agencies are already submitting income information to IRAS. For intermediaries in other industries, such as ride-hail service and taxi operators, food and goods delivery platform companies, IRAS will continue to engage them and work with them closely to understand and address potential operational and system issues so as to keep the compliance burden low. Mr. Ip Hong Wing inquired on how the government will ensure that the intermediaries comply with the requirement and the accuracy of the information obtained, as well as whether penalties will be imposed in the event of non-compliance, and if there will be whistleblowing policies in place. So IRAS will issue a one-time notice to inform intermediaries of the requirement to maintain the requisite information, as well as a yearly notice to inform them to submit information to IRAS. To ensure compliance, IRAS will adopt an approach similar to that for the auto-inclusion scheme for employers. During the initial phase, IRAS will continue to render support to the intermediaries while adopting a light-touch approach, such as issuing reminders or warning letters for non-compliance. Subsequently, actions such as composition or prosecution which include penalties of up to $5,000, could be imposed for non-compliance. IRAS has also compliance programs in place to detect and identify intermediaries who have made errors in the submission. This includes assurance audits to ensure that intermediaries have adequate controls to maintain accurate information. While intermediaries will not be unduly penalized for unintended errors or mistakes detected, they may be liable for offences. They may be liable for offences if errors are due to negligence or without reasonable excuse. IRAS also has an existing whistleblowing channel which the public can use to inform IRAS of any wrongdoing. Mr. Speaker, Ms. C asks whether the data used to determine the FEDRs accurately reflect the expenses incurred by delivery workers. The FEDRs were developed using income and expense data for the different delivery modes, which IRAS obtained from its consultation with the industry and survey with the workers. The current FEDRs strike a balance between simplifying tax compliance while ensuring that the ratios are reflective of the actual expense ratios of delivery workers. Now, let me reiterate, sir, that the FEDRs are optional. For those whose actual expenses exceed the FEDRs, they can claim deductions based on the actual deductible expenses incurred. Ms. C and Ms. Mariam asked whether IRAS intends to review the different FEDRs in the future to keep pace with changes in the cost of the delivery service, and if the initiative on mandatory income submission by intermediaries could assist in this review. IRAS will regularly review and assess the relevance of the FEDR rates based on available data, including income information obtained from intermediaries. For example, IRAS reviewed the existing 60% FEDR for private hire car and taxi drivers, which was implemented in the year of assessment 2019. They did a review this year. The latest data showed that while drivers' expenses have increased, their revenue has also grown due to increases in meter and mileage rates. Therefore, the 60% FEDR remains relevant and sufficient for the majority of drivers. And for those that this doesn't apply because their expenses are higher, as I mentioned earlier, FEDR is optional. They can submit the actual expenses. Mr. Speaker, members were concerned that the change in the Working Mothers Child Relief, or WMCR, will disincentivize higher income mothers from having more children. Mr. Yip and Mr. Satyandi asked if the government has taken measures to address these concerns and if we had considered alternatives in designing or redesigning the WMCR. So this issue has been thoroughly discussed and debated at budget this year. As DPM Wong had explained then, the WMCR change should not be seen in isolation. It is part of a package of moves to support marriage and parenthood, which has been strengthened over the years. For example, we announced at budget this year that we will be enhancing the baby bonus scheme and parental leave provisions, which benefit all couples, regardless of income. The change in WMCR will be effected prospectively and apply only to working mothers with qualifying Singapore citizen children born or adopted on or after 1st January 2024. Eligible working mothers of qualifying children born or adopted before 1st January 2024 will not be affected, as they can continue to claim the WMCR based on the existing design. As pointed out by Mr. Sharul, the change in the WMCR reflects our social compact of a fairer society, one which we provide more support for the less well-off, and in this case, lower and middle-income working mothers. We will continue to engage couples and parents to raise awareness of the package of support measures available for marriage and parenthood, including the enhancements announced during Budget 2023. Mr. Satyandi also sought clarification on the rationale for removing Foreign Domestic Worker Levy Relief, or FDWLR. The FDWLR was introduced in 1989 to support working married women who needed the help of a domestic worker so that they could return to the workforce. Since then, the government has introduced new schemes to directly support those caring for dependents, including working mothers. In particular, those living with children below 16 years old, elderly, or persons with disabilities may enjoy a concessionary FDW levy of $60 per month instead of the usual levy of $300 or $450 per month for the first and subsequent FDW, respectively. This concessionary levy directly benefits all families who need help with caring for their dependents, including those who do not pay income tax. Therefore, the FDWLR will be lapsed with effect from year of assessment 2025. Mr. Speaker, Mr. Louis Chua asked about the GST and whether it is possible to defer the 1% increase in 2024. So the proposed change and timing of our GST rate increase has been robustly debated in this House, but allow me to reiterate a few key points. We consider not just the year-to-year changes, but more importantly, the medium-term trend in our expenditures and revenues when we manage our fiscal resources. As we know, Singapore has an aging population, and we must expect that with an aging population, there will be rising healthcare costs. Government expenditure is expected to increase from the current 18% of GDP to potentially over 20% of GDP by FY 2030. This has yet to account for additional spending that may arise from new policy initiatives, including the need to further invest in resilience and to strengthen our social compact and economic competitiveness. On the revenue side, our tax revenue collections have grown broadly in line with GDP. The higher tax revenue collection in FY 2022 compared to the previous year was due to our economic recovery after the COVID-19 pandemic. It is unclear whether the trend can continue given the uncertain global macroeconomic outlook. In the medium term, revenue generally does not grow faster than GDP without tax rate changes. This is why the revenue measures announced at the recent budgets, including the GST increase this year and next year, remain necessary to meet our medium-term spending needs. Deferring the GST increase will only store up more problems for the future, leaving us with less resources to take care of our growing fiscal needs. And we cannot count on short-term upsides to fund structural needs. When the government has unexpected fiscal upsides, we share these surpluses with Singaporeans, including providing relief for households through cost of living support packages. Mr. Sharul mentioned this in his speech earlier. I'll just name two components for information. DPM recently announced a 1.1 billion support package, and one of these items would be an increase in the CDC vouchers that all Singaporean households will receive in January next year. So from 300, it has increased to 500, 250 for supermarkets, 250 for heartland shops. And we will also increase the special payment that eligible Singaporeans will receive, and there will be 2.5 million eligible Singaporeans by the end of the year. So there will be an amount depending on your income, but up to $800 per eligible Singaporean. And this will include many of our Singaporeans, including our retirees, who are staying in private properties, because this doesn't look at your property type, it looks at your income, as long as you don't own 2 or more properties. So we understand that Singaporeans are concerned about the GST increase and cost of living. On delaying the GST increase for 1 or 2 years, what we have done is actually better than that. With the assurance package, we have delayed the impact of GST increase for the majority of Singaporean households by 5 years, and by about 10 years for lower income households. The government remains committed to doing so, even with elevated inflation. This is why we have substantially enhanced the assurance package over the past 2 years. And the government has also announced additional support measures to help families with rising cost of living, beyond the GST increase. The assurance package was most recently enhanced to now total amount over $10 billion, with the COL package announced by DPM last week. There is some additional relief for all Singaporeans, with more for lower and middle income groups. Sir, Budget 2023 is an expansionary budget. It is less expansionary than the previous year's budget, and this is to avoid adding to elevated inflationary pressures while supporting our economy and helping families in a more uncertain global environment. We achieve this balanced outcome by focusing more of our support measures on the lower and middle income groups while providing some help for all Singaporeans. Mr. Speaker, several members, Mr. Don Wee, Ms. Chandra Das, Mr. Sean Huang, Mr. Keith Chua, Ms. Louis Ng, Ms. Nadia, and Ms. Mariam expressed support for and sought clarifications on the Philanthropy Tax Incentive Scheme, or PTIS for short. Allow me to share more about the scheme and in doing so address their questions. First, under the PTIS, approved qualifying donors can claim 100% tax deductions for overseas donations made through qualifying local intermediaries. Overseas donations refer to cash donations made towards any charitable, benevolent, or philanthropic purpose whose main objective is to benefit persons, events, or objects outside of Singapore. These could include overseas philanthropic causes in sustainability that Mr. Wee mentioned, as long as all the other criteria are met. MAS is committed to processing applications to be approved qualifying donors and local intermediaries in a timely manner. Second, to ensure oversight, as highlighted by Ms. Mariam, MAS requires all participating single-family officers, or SFOs, to submit annual review returns. In addition, as SFOs are required to channel their donations through local qualifying intermediaries, these intermediaries also conduct due diligence checks. Third, to benefit from the PTIS, SFOs would have to meet two conditions. First, appoint and maintain a philanthropy professional at the point of application and throughout the incentive approval period. And second, incur an additional $200,000 in local business spending and employ an additional local professional headcount in the financial year when the overseas donations are made. These conditions that Ms. Chandradas asked about are made known upfront to the SFO applicants, and they are required to declare that they have met the conditions in their annual returns to MAS. If the conditions are not met, the legislation provides for the government to claw back the previously granted tax deductions. Fourth, members spoke about ensuring that the local charity sector is not excluded from the benefits of PTIS. Indeed, it isn't. By requiring that overseas donations take place through qualifying local intermediaries and requiring that SFOs have to appoint and maintain a philanthropy professional, the PTIS serves to uplift philanthropic capabilities within the charity sector in Singapore. Qualifying local intermediaries would include institutions of public character with a valid permit for fundraising for foreign charitable purposes. Overall, some members advocated for more overseas philanthropic giving across a wider spectrum of society, while others spoke about the need to ensure that the philanthropic giving also supports local causes. I'm glad that members agree that philanthropy makes our society better, and given their different views between overseas and local giving, that they appreciate that the government needs to strike a balance between the two. Beyond the PTIS, the government has other tax incentive schemes to encourage local philanthropy. For example, qualifying local donations made to the institutions of a public character and other eligible institutions enjoy a 250% tax deduction until 31st December 2026, which is higher than the tax deduction for overseas donations. The government will continue to review our schemes to foster and sustain the spirit of giving. Finally, many members have expressed support and interest in the Enterprise Innovation Scheme, or EIS, announced in Budget 2023. I thank them for their support. Mr. Satyandi asked about the rationale behind raising R&D tax deductions to 400%. The parameters of the EIS are set to provide modest but meaningful support for businesses in their drive to invest in R&D. Looking across comparable economies which offer similar tax deductions on R&D activities, a 400% tax deduction is competitive when compared to jurisdictions such as Hong Kong and Malaysia. Mr. Satyandi, Mr. Sharil and Ms. Nadia asked about the effectiveness of tax deductions on innovation and its outcomes. R&D tax measures do lead to an increase in innovation activities, as they help to mitigate risks and gives an additional boost to returns on investments. That said, tax deductions cannot operate in isolation and must also be complemented by a developed R&D ecosystem to promote innovation, which the government continues to invest in through our research, innovation, and enterprise plans. In Singapore, we have seen a promising increase in business expenditure on R&D over the years, from $3.8 billion to $6.6 billion between 2010 and 2020, which points to businesses' underlying desire to innovate. During the same period, we also saw almost a threefold increase in sales revenue from commercialized products attributed to R&D performed in Singapore. These are promising trends, but we know there's room for our economy and our enterprises to invest even more in R&D so that we can be more globally competitive. The EIS, together with our broader ecosystem of grants, incentives, financing tools, and R&D talent, will give businesses an additional boost. Mr. Ip, Mr. Wee, and Mr. Huang highlighted the importance of encouraging local SMEs to take advantage of the EIS to innovate. While SMEs have shown promising growth in R&D expenditure, we recognize that many SMEs are less likely to have the skill to undertake R&D on their own. This is why we are introducing a new tax deduction for expenditure incurred on innovation projects which SMEs more commonly undertake rather than R&D. The tax deduction will apply for qualifying innovation projects carried out with partner institutions such as the polytechnics, ITE, and the centers of innovation, and could relate to business process redesign or deployment of productivity equipment. These would not be considered R&D in the strictest sense, but are nonetheless useful to help SMEs to kickstart their innovation journey. Undertaking innovation projects with these partner institutions will also enable SMEs to tap on the existing expertise there, instead of having to acquire or develop their own. Mr. Ip asked if the expenditure cap of $50,000 can be revised upwards to cover higher-end research with higher costs. Sir, allow me to clarify that these innovation projects will not typically exceed the $50,000 cap. Businesses that undertake research that meets the R&D definition can tap on the enhanced deductions for their higher R&D costs, which has a higher expenditure cap of $400,000. Many of the projects undertaken in partnership with the universities would be able to qualify for the enhanced R&D or IP-related deductions. Nonetheless, we will observe the uptake of this new deduction for innovation and consider whether we could expand the list of partner institutions where appropriate. I also thank Ms. C for highlighting the cash flow concerns of businesses when they undertake innovation activities. We will monitor and study how we can further support our businesses in their innovation journey, including encouraging them to work with NTUC to form company training committees. Ms. C suggested providing some upfront subsidy for innovation similar to what we are doing for training courses, but the context between innovation and training is quite different. Unlike training courses, which can be pre-approved and subsidized upfront, investments in innovation are varied, differing by sector, scope, and the business's level of maturity. It is therefore difficult to pre-approve innovation expenditures or provide upfront subsidy. Beyond government support schemes like EIS, it is important for businesses to take the initiative and embark on the innovation journey to improve their competitiveness. They have to set aside adequate cash flow for investing in new equipment and developing the necessary capabilities. Mr. Wee and Ms. Nadia asked about the development of human capital to support businesses' innovation activities. Mr. Shahril also asked if the list of eligible causes should be narrowed down. We recognize the importance of training workers to support a business's capability to innovate. Hence, the EIS introduces enhanced tax deduction for around 10,000 SkillsFuture Singapore subsidized courses. These courses support industry transformation and workforce development needs, and will support a range of enterprises from different industries at various stages of their innovation journey. They also include courses that cater to freelancers from the creative industries. SkillsFuture Singapore will continue to monitor the relevance and effectiveness of courses eligible for EIS deductions and refine the list of courses accordingly. Mr. Shahril asked if the government could request proof of value before the tax deduction on training is granted, and if the deduction can be limited to employees who have served a minimum number of years to minimize abuse of the scheme. Even with a 400% tax deduction, a firm will need to co-pay for training. This will help to ensure that the firm sends its employees for training only if it will create value for the firm and support its innovation efforts. The firm, the employer, has skin in the game. The $400,000 training expenditure cap for tax deductions will further mitigate the risk of abuse. The government will monitor the take-up of the EIS, businesses' investments in R&D and innovation, as well as feedback on the scheme. And this will allow us to continually review the scheme's effectiveness, and we will refine it along the way. Ultimately, what we want is to have a scheme that can support companies to embark on innovation, because we know innovation is key to future economic growth, is key to creating good jobs for our workers. So I encourage businesses to learn more about the EIS through the information available on the IRA's website, and we will also work with industry partners, such as our trade associations and chambers, to raise awareness amongst businesses. Mr. Speaker, I beg to move.
Any clarifications for SMS? It was a very comprehensive 32-minute roundup. Okay, I don't see any hands. The question is that the bill be now read a second time. As many as are of the opinion say aye. Aye. To the contrary say no. I think the ayes have it. The ayes have it.
Income Tax Amendment Bill.
Committee stage what day?
Now, sir, I beg to move that Parliament will immediately resolve itself into a committee on the bill.
The question is that Parliament bill immediately resolve itself into a committee on the bill. As many as are of the opinion say aye. Aye. To the contrary say no. I think the ayes have it. The ayes have it. The question is that clauses 1 to 57 stand part of the bill. As many as are of the opinion say aye. Aye. To the contrary say no. I think the ayes have it. The ayes have it. Bill to be reported. DPM and Minister for Finance.
Mr. Speaker, I beg to report that the bill has been considered in committee and agreed to without amendment.
Third reading what day?
Now, sir, I beg to move that the bill be now read a third time.
The question is that the bill be now read a third time. As many as are of the opinion say aye. To the contrary say no. I think the ayes have it. The ayes have it.
Income Tax Amendment Bill.
Leader?
Mr. Speaker, I beg to move that Parliament do now adjourn.
The question is that Parliament do now adjourn.